In this short video, I want to look at a way that a particular derivative can actually help you if markets take a dip. And that derivative is a thing called a put option. So there it is. And a lot of people associate derivatives with two things: risk. Well, actually, derivatives can be used perfectly safely if they're used the right way, and scariness. But actually, it's the jargon that puts people off. So hopefully here I can reassure you on the jargon and give you at least a flavour for how these things could be quite useful. So let's have a look at it. What's the challenge? What are we trying to do? What's the problem we're trying to solve? FTSE 100 is looking a bit toppy in the short term, it's looking a bit high, a bit nervous. So is there something I can do? Well, I could sell all my shares, wait and see if I'm right. When it falls, buy them all back. That's fraught with problems. I don't want to pay the transaction costs, the stamp duty when I buy them back. I might trigger a tax liability the moment I sell. It's a hassle, and if I get it wrong, then I've got a sort of double whammy. I've lost money, I've got to replace all my shares. So maybe I want to hang on to my portfolio and protect myself in the short term against any downturn. Now, there are other ways to do this. I've done a video called talking about CFDs. There are other ways this can be done, but here I'm going to look at something called a put option as part of the menu of ways of doing it. Okay, so there's the challenge, and here's my suggested solution in this particular case. So a look at the FTSE 100. Is this a useful thing to want to do? Well, yes, it is. The FTSE 100, as I speak, early 2015, may have sort of breached new all-time highs, but in getting there, it's had some ups and downs. So going backwards, December 1999, close to where we are at the moment, 6,950, and it's been as low as 3,530 between then and now. So quite a lot of volatility, quite a lot of shorter and longer term dips. You can see them all over the place on this chart. So places where somebody who's a long-term investor might want to almost take a little bit of risk off the table without necessarily dumping their portfolio. Okay, options basics. What are these things? Now, to get your head around options, think of the option as a piece of paper which you can either buy or sell. If you buy the piece of paper, you are physically holding it. If you sell it, you've got to have created it first, so you'll have written it first and then sold it. Now, I know these things are all electronic now, but that can help with the language. So you've got a piece of paper. An option gives the holder, that's the person who's physically got it, if you want to see this as a piece of paper, the right to buy or sell. Now, let's introduce some language here. Buy or sell, call or put. Why on earth would you call a piece of paper that gives you the right to buy a call option? Well, imagine you're standing in a pit opposite somebody else. You would literally call 1,000 shares over to you. Literally do that with your hands or put them away. So it's just language, just jargon. It puts people off, but don't let it. The right to buy is known as a call option. The right to sell is known as a put option. A specified asset, that could be anything. Let's deal with, say, 1,000 shares. So the underlying is 1,000 shares on or before a specified date, known as the expiry date. So this piece of paper doesn't have an unlimited shelf life. It dies at a certain point in time, and at a specified price called the strike. So lots of jargon. So this is a piece of paper that will allow you to either buy or sell. Now we're going to look at the right to sell in this video. A specified asset, the contract may say 1,000 shares, for example, on or before a particular date when the option expires, so it's use it or lose it, at a specified price called the strike, and that's fixed in the contract. Now you pay for this. Whoever's going to sell you this piece of paper is going to want something for it because it gives you a choice. And whenever you get a choice in financial markets, you can expect to pay someone else for giving you that choice. Okay, so let's do some basics. So we've got two people involved. All right, because it's a contract between two people, let's say. One of them pays a non-refundable premium up front. In return, they get the right to sell 1,000 shares, so here it is, for £2 each. There's that fixed strike price, that's set in stone, that's not going to change any time in the next 3 months. Why would you pay for what's essentially a piece of paper? Unless you're mad or a charity, why would you do that? Well, there must be a reason. Presumably, you are thinking, well, if I hold a piece of paper, hence the language, if I hold a piece of paper that someone else has written out and sold to me, and it gives me the right to sell for a fixed price, why would I want to sell something in the future for a fixed price? I must be worried that that something, i.e. my shares, are going to dip. And if they do, I can offload them at a guaranteed fixed price, because that's fixed in the contract. So presumably I'm worried about the shares I hold dipping below £2 over the next 3 months. All right, and it's use it or lose it. So if we get to the end of 3 months and they haven't, piece of paper goes in the bin, it expires, I lose the premium, and that's the deal. So essentially, the holder's on the left, the writer is over on the other side. There's the put option, if you like, the piece of paper, giving this person the right any time in the next 3 months once to effectively say, I want to use it. I want to offload 1,000 shares at £2 each. The writer gets a premium up front, which is non-refundable, for taking the risk of creating this bit of paper. They're going to be waiting nervously to see if a phone call comes in. Because remember, if a phone call does come in from the holder, they are going to have to take the shares, regardless of the market price, at £2 each, potentially. So you have a bear on the left, someone who's nervous about prices falling and wants this piece of paper as insurance. And you've got a bull, presumably on the right, who's thinking, why would you pay me 200 quid for that? I don't think share prices are going to fall, and in a market, you'll get two views. All right? So the writer's thinking, this is money for nothing, because I'm not expecting the call to come in. The holder's thinking, I need that insurance, I'll pay 200 quid for it now, and I will need it in the next 3 months. Now, what could happen next? Some people like graphs, some people don't. I've called this the put option payoff graph, and I don't get put off the video by that. Essentially, it looks a bit like this, and I'll just give you 3 examples of what could happen next, now the bit of paper's been set up. Imagine, if you will, that the underlying share price at the end of 3 months, let's say, is £3, and you're the holder, you've got the piece of paper. Are you going to use a piece of paper to sell 1,000 shares for £2 when you can get 3 in the market? No, you're not. You'd sell the shares in the market if you needed to, you put the piece of paper in the bin, and you've lost out on your £200 or 20 pence per share. That's your loss. Equally, in an extreme case, if the shares you're holding collapse to 0, you would very definitely make the phone call, offload your shares for £2 each, but the premium's sunk, 20 pence per share. That's not coming back no matter what you do, so you've made a profit of £1.80. Big profit, in other words, from having that put option. Worthless shares can still be offloaded at £2, but you've paid a 20p premium. There's your £1.80. And somewhere in the middle, for those people who are interested, you break even. If you were to decide you want to exercise the option to sell for £2 when the share price is £1.80, well, what would you be doing there? In theory, you'd be selling something for £1.80, sorry, beg your pardon, you'd be selling something for £2 that's only worth £1.80, so there's a 20p profit, but the premium is non-refundable, so that cancels it out. So you kind of break even around there. So you can see the motive for the person holding the option is to exercise it when they need to, and that's where the underlying share price falls. If it rises, they're not going to be interested in selling shares for less than they can get in the market, so they lose the premium. Some people like graphs, some people don't. All right, in summary then, what am I suggesting? It's all about combining 2 positions. I hold shares, I'm worried about a short-term dip, so I'm holding put options. Just know, either on those shares specifically or on an index that sort of represents them. So, if your portfolio is FTSE 100, you might use put options on the FTSE 100 rather than individual shares or constructing some basket that exactly represents them, because that's kind of hassle and expensive. What could happen, in summary? 3 things I'm suggesting. If the shares rise, this is from the perspective of the person who holds a piece of paper and has got the underlying portfolio, the option's going to lapse. You're not going to use it. So the profit you make on the shares you're holding, because they've gone up, is just reduced a little bit by the £200 premium you've paid up front. So you've sunk the premium into the insurance policy and not used the insurance, if you want to see it that way. If the shares fall, you're probably going to use the option. You're going to offload them at the fixed strike price, in which case it's a profit on the option, net of the premium paid. In other words, you're going to make money from the option, potentially, which will hopefully offset the fact that the underlying shares have fallen in price. And if the shares stay static, I didn't give you a specific price up front in the example, but if the share price doesn't move, presumably the option will lapse, in which case you lose the £200. And if you're thinking, in that case, options are slightly weighted in favour of the person who writes them, that's absolutely correct. They are slightly in sort of probability terms. All right, so there you have it. A few words of caution at the end. Options are geared products. All right, they buy you a lot of bang for your buck, but you can potentially lose quite a bit of money too. They're not suitable for everybody, so do take advice before going near options. What I've suggested there is there is a reasonably safe use of options as a type of portfolio insurance, or sort of, to give it the grand title, hedging tool. Quite a lot of ground covered fairly quickly there. Any questions as usual, please email me at editor@killick.com.